equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 20 minutes or less. We break down the world of investing from beginning to dividends so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. How are you?
Good. I'm excited for this episode because unlike the stock trading competition where you are handsomely beating me,
Yeah.
I feel like this is where I get my vengeance and
Emphasis on handsomely.
Okay, I get it. So at the start of the year, 24th of January, made some bold predictions and chose two stocks that we thought would be stocks of the year for 2019. We've decided that this is a good opportunity as it's the end, well, we're well past the first quarter of 2019 calendar year. We're going to review what those stocks were and have a bit of a look at a discounted cash flow and evaluation for both of them and see who at the moment is coming out on top. So let's get stuck into it.
Yeah, we are.
Who wants to go first?
Well, we'll save the winner to last. We'll save the best to last. So I'll go first.
Okay.
Not giving anything away, but unfortunately, my stock of the year pick has gone down. So I picked Costa Group.
Yeah.
They are one of Australia's largest horticultural companies, produce fruit and veg. Some of their main categories are berries, mushrooms, and citrus.
Avocado.
Avocado is a big one as well. You loved your smash avo, so you'd be all over that. Yes. And as people may or may not be familiar with, it's tough to be a farmer right now.
Yes.
Between droughts, bushfires, hurricanes, everything, it seems the weather isn't kind, and that is affecting these companies and these farmers. If you've been into Coles or Woolies recently, the price inflation on fresh produce is extremely noticeable.
I have certainly noticed in broccoli.
Yeah.
Holy moly.
Yeah. So that obviously affects these companies as well, because if the price is going up and people might be paying more for it, that might give a short-term bump to their revenue numbers. But eventually people will stop paying that much and stop buying it. And also it doesn't help their profit numbers as well, because the cost to grow it is increased. So that has affected Costas. On January 24, when we released the episode, it was trading at $5.41 a share.
Yeah.
As of today, April 14, when we're recording this, $5.07 a share, which means it's down 34 cents or 6.3%.
Down 6.3% in 3 and a bit months.
Yeah.
And so can you just remind me why you decided this was going to be your stock of the year?
Yeah, so I, right before we picked, it actually fell a lot more. It fell, from memory, about 20% or something in a day, from about $7.40 to $4.50. So in percentage terms, that would be something like 37% fall in a couple of days. And that was after they announced to the market that they were going to have some difficulties in a few of their key areas, their few fruit and veg lines. So that was sort of mid-January, and then that's when we were looking, and I was like, the market may have overreacted here. I think there might be a bit of mean reversion coming, and I still think there might be. It just hasn't happened yet. And so I got in, and it's basically traded. Well, it's traded more or less flat, but it's just trending down a little bit recently. So look, it is a really tough time to be in the fresh fruit and veg business, and that may not change anytime soon. But if there's going to be a type of company that is able to withstand it, it's a company with a diversified portfolio of assets and a decently strong balance sheet that can withstand this pain and hopefully come out the other side stronger than ever.
So you're still bullish?
Oh, look, long term, I think it's an interesting company. In terms of beating you in this stock of the year, not confident. We'll get to your update in a minute. But I think Australian agriculture has some competitive advantages. I think it's proximity to Asian markets. I think the arable land we've got. I think companies trying to produce and export some of this stuff are in a pretty good position. And I think Costa's got a decent portfolio of assets to try and do it.
Yeah, agreed. I think it's a good company.
Yeah.
Yeah.
Well, if they could pull their finger out and help me win Stock of the Year, then that would be great as well.
Yeah, so if anyone from Costa is listening, take Ren's advice.
Yeah.
So, okay. Still a long way to go, though.
Still a very long way to go.
So anything's possible. All right, Ren, so you've done Costa. My pick for 2019 was Baby Bunting, off the back of the episode that we did in our summer series where we did a bit of a deep dive into it. And they have been kicking goals somewhat since. When we released the episode on the 24th of Jan, it was trading at $2.13. Since then, it's trended up, had a few good days, few bad days, but overall it's up 21 cents or 9.86%.
Wow, not bad.
So pretty solid return. You would absolutely take that. Again, probably should have put money where our mouth is, but I don't have any money in Baby Bunting. Do you?
I don't know.
No. So they've been performing well. Some numbers to call out, and it's a number that we've spoken about before in retail, and that's comparable store sales growth. For their first half, they had comp growth of 9.5%, which for retail is pretty decent.
Yeah, that's very good.
Yeah, so total sales were 177.7 million, up 17.2% on the corresponding period. Their gross margin is up 34.6%, so pretty decent margin as well. And their profit income is up 22.9% to 61 million. So performing pretty well. They paid a dividend of 3.3 cents, and they are giving a guidance that for the end of 2019 FY, their EBITDA is going to be between 25 and 27 million. So we will see what they report coming into the second half of this year.
Yeah. I guess before you go on, the thing that I'd love to know if I was thinking of investing in them is their same store sales growth is up 9.5%. I'd love to know what that is normalized for all the companies that have gone out of business, because, you know, like, is the company itself doing better, or do they just have less competition?
Yeah, it's a very good call out, and
look, potentially it doesn't matter what the answer to that question is, because if they are the only people left and they're getting that business, then great.
So be it. Yeah.
But I guess also long term, you know, there are less physical competitors. But if we apply a longer term lens to it, the competitors are still there. They're just online.
Yeah.
And if Baby Bunting aren't improving their offering, aren't improving their service levels, and aren't delivering for their customers, and they're just the last person standing, well, then will they be standing that long?
Yeah, very, very good question. And that's what I was trying to think when we were doing this discounted cash flow, to get a bit of evaluation, like how truly sustainable is the growth rates that they're seeing at the moment? How real is it, I guess? Obviously, if you read through the presentations and comments from the CEO, they're very bullish over the next sort of 3 to 5 years. They see this as a real opportunity for them to grow online, for them to capture, as you were just saying, the markets that are now have been left by their competitors who have gone out of business. But you know, there's certainly going to be a point where I guess they capture it, and it's a matter of then how can they grow that market once they capture it.
Yeah, and for people who aren't familiar with what's happened to the baby industry, the baby goods industry,
yes.
not selling babies, but selling goods for babies. We did a deep dive in it in our summer series. We have a look for that in the podcast feed. It's a pretty fascinating case study at the moment. Baby Bunting has really, well, you couldn't say they've Stephen Bradbury'd it, because they were the biggest player in the field before. But literally, you know, their 4 biggest competitors all have shut stores and gone out of business. Yeah. They are just cruising to this dominant position.
Yeah. So you'd almost expect then if they weren't able to be getting the numbers that they are now and weren't delivering what they are, then there's something wrong.
Yeah.
Seriously wrong.
Yeah.
So, Ren, they're trading at $2.34 or whatever it was, $2.34. So I thought it'd be a good opportunity to throw a few figures into a discounted cash flow calculator online. Anyone out there who wants to have a crack, we're just using one on moneychimp.com.
Not sponsored.
Not sponsored.
If a particular discount cash flow calculator wants to sponsor us, we are open to it.
So this is essentially a model used to determine valuation of a stock. Won't go into too much detail. We can go into that later. But Ren, I'd like your input into this because there's a lot happening in the retail space at the moment.
There is.
And it'd be interesting to get your thoughts. So particularly around growth assumptions.
Yeah.
So for Baby Bunting, they're giving guidance for next year of sales growth of about 35%.
Okay.
Which is rather large. But so let's look at growth assumptions. So the earnings are expected to grow at a rate of, I've put in 7% annually for the next 2 years, before leveling off to an annual growth rate of 4% thereafter.
Yeah.
And that is with a discount rate of 10% because of the market, and an earnings per share of 0.08 cents or 8 cents. And that comes out at a valuation of $1.47.
Okay.
So it's currently valued currently on the market at $2.34.
Yeah. I think the thing there is the 2 years that's a very short before it gets into the terminal growth period.
Okay.
I think normally you do 5 or more.
Okay.
Yeah. So why don't you change that to 5? Yeah.
So $1.58.
Okay, it didn't change that
So
much.
not a massive difference.
Yeah, there you go.
If I put in 10 years at 7% for the next 10 years, it's coming out with a valuation of $1.74.
Yeah. Your discount rate is, 10% is, it's not crazy, but...
You think too high?
No, not necessarily. But that's what's keeping the number low as well.
Mm.
Like if you did it and you said the discount rate, like the risk-free rate is actually, 4% or something, then your number would be markedly different.
True. So there you go. Coming out of $1.74 at 7% annual growth for the next 10 years, which I don't know if that's sustainable or not, but certainly over the next couple of years, you would expect it to grow more than that. So yeah, $1.74.
There you go.
Overpriced.
So I've done a similar thing for Costas, and it is currently trading at $5.07. So earnings per share for the last financial year, 17 cents. Earnings are expected to grow, I said, 7% annually for the next 10 years, and then a terminal growth rate of 2% thereafter, which is essentially inflation. And I said the discount rate was 7%, and it came out at a value at $5.17.
Oh, so pretty on par.
Broadly in line. Yeah.
Wow, okay.
Yeah.
So from a value perspective, Costa seems like it's...
Well, I think there's a few things in there. So one is that the earnings per share last year won't be... it's an open question how close they'll be to the earnings per share this year, because in the intervening time they've had this market announcement, the share price fell 30%, and it's hasn't really rebounded that much. So if you halve those earnings, then everything changes from there. 7% growth rate, potentially challenging environment to achieve that with the cost pressures involved in their business and drought and stuff like that, and then the discount rate of the 7%, if you up that to 10%, then the value will be lower. So I reckon we'll do a full episode on discount cash flow at some point.
Definitely.
But in a nutshell, all you're really asking is what's the value of this company in relation to the other investment options out there, and in particular as a value investor who the main thing is you don't want to lose your money, is what's the risk-free rate of return that I can get, and how does this investment compare to something that I can get without taking any risk? Yeah.
Which is usually government bonds.
Yeah.
No, I agree, Ren. Very important to understand the discounted cash flow, especially if you're a value investor. And we will endeavour to do an episode on it. I think it's a really good idea. Basics 101, break down discounted cash flow. So we were just using one online, very easy to find. And you can have a play around with some of the stocks that might be in your portfolio as well. So I think, Ren, for the first time ever, we've actually come in at under 20 minutes.
Have we?
Yeah.
Oh, not bad.
So unless you want to waffle for another five.
Do you want me to talk about discounted cash flows a little bit more?
No.
No, I think, look, let's call it there. You're beating me well and truly.
Yes.
But I'm beating you in the next top trader competition. So,
Yeah, so maybe you're actually more of a short-term trader kind of guy.
Maybe.
There you go, despite what you think. All right, Ren, we'll leave it there, and we will see how these pan out over the next couple of months. Probably check in at the halfway mark, maybe.
Yep.
And see where we're at. But until then, we'll chat next week.
Sounds good.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.